Zscaler just released their latest quarterly figures, a pretty good quarter. Beats across the board for a quarter, but as we've seen with plenty of other companies, it's not enough. Guidance needs to be good as well, especially for expensive stocks. And so, at the time of making this video, Zscaler stock is down 16%. Now, most of you that have been following the channel for a while, you know that 3 months ago I did a Zscaler earnings video as well, and Zscaler was actually up, I think, 15% or so. So now we're going back to, well, numbers not seen since 3 months ago, which was exactly the day before Zscaler reported. The stock was around $158 or so. So now we're 3 months later. You get more numbers, more information, and so maybe you might be making better decisions. Like I said, this is not a cheap stock right now, has a forward PE of 58.9 times. And by the way, this is not a slow growing company. Yes, maybe growth is slowing down a little bit, but this is not a slow growing company, and it's not expected to be one either in the future. Still, over 20% year-over-year growth, top and bottom lines. Of course, when you're coming from 30-40% growth, then yes, growth is decelerating, and the premium that you're putting on this stock needs to come down as well. If we're looking at what has happened before, well, before the stock was even more expensive, right? If you compare it to its 5-year mean or 4-year mean, I should say, it's now much, much cheaper than before, but it's not cheap. Although, if you compare it to other cybersecurity companies, right? If we look at forward PE for Palo Alto, 56.6 times, CrowdStrike 72.5 times, EV to EBITDA, Palo Alto 41 times, CrowdStrike 63 times. So when you compare it to its peers, it's not that crazy to be valued at this premium. It's just that the sector is very, very expensive right now. And this is very important to note, not just for cybersecurity or Zscaler or whatnot, every other industry. When you look at a certain company, don't just compare it to the average market. No, also compare it to its peers. Because let's say right now with Zscaler, you would have thought, oh, it's super expensive. No buy. Might not be a buy either, as you will see in just a second. But when we look at its competitors are also not trading at cheap valuations. So maybe this is the norm. Maybe this is the norm. Of course, we would always like to buy at cheaper prices. Yeah, that's just how we work, right? Anyways, before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so let's start here with a couple of comments. We ended a successful fiscal 2024 with Q4 results exceeding the high end of our guidance across all metrics. Customers' adoption of our Zero Trust Exchange platform is stronger than ever, and I'm thrilled to share that we have achieved a major milestone with our cloud platform surpassing over 500 billion transactions daily. I'm excited about the year ahead as we enter fiscal 2025 with a strong go-to-market machine and a high pace of innovation. So if we look at the results for Q4, the results again exceeded guidance for most of the stuff here. So revenue increased 30% year over year. Calculated billings is up 27%. Calculated current billings also up 27%. Gross margin of 81.1%. Operating profit of $128 million, well exceeding their own guidance with a 21.5% margin. EPS of 88 cents. 38% growth year over year, also well exceeding guidance, and a free cash flow margin of 23%. A dollar-based net retention rate of 115%, and operating profit is up 48% year over year. If we look at the fiscal year, because their fiscal year 2024 is over, they're now entering Q1 fiscal year 2025 for them. Revenue increased 34% year over year. Calculated billings up 29% year over year. Operating profit margin of 20.4%. EPS of $3.19. They were expecting $2.20 to $2.25, and a free cash flow margin of 27%. So again, a tremendous year for them, great growth. Now, of course, as you will see in the guidance for Q1 and fiscal year 2025, well, growth rates are coming down again. As for the rule of 60, now for the fourth consecutive year above 60%. So here 34% revenue growth year over year with a 27% free cash flow margin, reaching 61% rule of 60 for fiscal year 2024. Now, SaaS companies aspire to achieve rule of 40. They say this, of course, because revenue growth for next year is not going to be 34%, which you can see right here, right? For the next quarter, they expect revenue to grow 22% year over year, gross margin of 80%, operating profit margin of between 18.8 to 19.2%, earnings per share between 62 and 63 cents. But for the fiscal year 2025 guidance, you have to take into consideration that now non-GAAP tax rate is going to be 23% for the fiscal year 2025. So that is higher. But here as well, you can see revenue for the fiscal year 2025 only growing. Of course, compared to what we've seen before, this is much lower, only growing 20 to 21% year over year. Calculated billings growing 19 to 20% year over year, and an operating profit margin of between 20.2 to 20.8%, which is better than fiscal year 2024. And so if we compare it to what the market was expecting, friends here are consensus gurus, show us the misses for Q1 and for the fiscal year 2025. The misses come from operating income, a miss of 3.4%, operating margin, a miss of 66 basis points, and an EPS miss of 16.7%. Same for the fiscal year 2025. Now, again, it's quite strange that the analysts have not taken into consideration that, well, the tax rate can go up or will go up. Maybe communication from management wasn't clear, but this could definitely explain these huge differences here. Anyways, continuing here on a couple of comments that were mentioned in the earnings call, or maybe one comment, and this is with regards to, of course, the Microsoft CrowdStrike related outage in July, and while Zscaler is designed in a way that's highly available and frankly relied upon by customers as an inline solution. But the analyst was wondering if that event in any way, from what they could tell, has changed the way customers are thinking about their cyber strategies and Zscaler's place within that. To which the answer is this. It's a good question. After the CrowdStrike outage, customers are more focused on resilience, which is our strength. In fact, I personally got a lot of calls right after the incident. They wanted to know about what we are doing about it, that we ended up personally inviting actually wide invitation briefings to 1,000 or so largest customers. Was surprised to see that within a matter of a week or so, about 700 customer registers for the briefings. They ended up doing multiple of them. Of course, this is great to hear, but eventually you would like to see this reflected in the numbers. But as we know, we've talked about this with Sentinel-1, with CrowdStrike, these things take time. We also already have a couple of comments from some analysts. Most of them are not as bearish as the market right now. So Piper, solid end to fiscal year overshadowed by fiscal year 2025 billings seasonality. Despite the fourth quarter upside across all metrics, a back-end weighted billings mix due to numerous factors sent shares sliding in the aftermarket and erased the prior month's gains. As underlying trends towards larger deals were solid, we have confidence in the company's ability to execute and believe shares set up well from here with a price target of $215. As for Jefferies, they talk here, of course, also about billings growth of 27% compared to consensus of 24%. That was also overshadowed by the first half of 2025 guide of just 13% year-over-year growth. While go-to-market changes and previously weaker first half results weigh, we think fiscal year 2025 potential billing trajectory remains similar, low to mid-20s growth implying 3 to 5% beat versus the 19% guide. That said, guidance justifiably implies competitive and TAM penetration cues. We still view Zscaler as a SASE leader in the early market innings, and shares should find a floor at $150. He has a price target of $225. And so if we're looking at the chart right now, of course, previously, like I said, the stock was closer to $200. It seems that 200 was a rejection point twice already. Now we're going back down closer to where we were at the start of August, that Black Monday, August 5th, and also closer to, well, the previous earnings report. Like I said at the start of this video, maybe 155 or so could be the bottom. Let's see. I mean, previously we've stayed around those prices for quite a while, so let's see what happens this time. But yeah, definitely 150, 155 could be a good area to start adding. And so overall, to conclude, I think this was an excellent quarter by the company. I think the company has a bright future. Remember, this is still a very, very young company compared to all the other players in that market. But I do feel that it was, again, one of those examples of being priced to perfection. And when you don't deliver, especially not on guidance, well, you're going to get hit and get hit quite hard. For long-term investors, I do think some opportunities will arise, especially since we are in September. As we've spoken about it yesterday, September is usually not a good month for the stock market, so maybe some good opportunities for long-term investors. Don't chase the stock. Wait for a maybe broader market rebound before jumping in. So that's about it for me. Of course, do share your thoughts down in the comment section below. Like, subscribe, do all of that, and I see you all in the next one. Bye-bye.